Hey guys, welcome back to another episode of Sky's the Limit podcast. I'm your host, Mike Doherty, and today we have awesome guest Erik Oliver from Maven Cost Segregation. Erik has actually been on the show before where we talked all things cost seg, but there's been a couple changes since our last episode, so we wanted to bring him back, talk about those changes and what a lot of our investors can benefit from going forward, specifically around the big beautiful bill, depreciation recapture. So we'll touch upon a lot of good stuff in there. And with that, Erik, welcome. Thank you for coming back.
Yeah, thanks, Mike, for having me. Glad to be here.
So for those that didn't get a chance to listen to the first episode or the first airing about cost seg, why don't you give everyone listening now just a brief definition or overview? What is cost seg? Why would you want to use it? And all the benefits around it.
Yeah, so good question. Cost segregation, it really is just, in its simplest form, it's just accelerated depreciation on your real estate assets. So one of the big benefits of owning real estate is the government allows you to take this depreciation expense off of your income every year, um, and reduces your tax liability. So it's a non-cash expense. It's no different than going out and buying office equipment. You get to expense that from your income. But in this case, you don't have to go pay for stuff. You've already paid for it, which is the building or the structure. So depreciation on residential units usually goes over 27 and a half years. And then on commercial units, it's 39 years. So we'll use a residential example. Let's say I buy a single family home for, let's just make the math easy, 275,000. If I take that 275,000, I divide it by 27 and a half, I essentially get a $10,000 write-off every year for the next 27 and a half years, which is great. That's, why a lot of us get into real estate is for some of the tax benefits. The only problem with that scenario, that's called straight line depreciation, by the way. So that's just taking a standard straight deduction every year. The only problem with that is I may not own my property for 27 and a half years, and I want my deductions now versus letting the IRS hold on to these for the next 27 and a half years. Number of reasons why we want to front load or take bigger deductions sooner. There's time value of money, there's inflation. I want to be able to take my tax savings and go reinvest it in a new property again versus letting the IRS hold on to it. So the way we're able to front load that depreciation is through an engineering based study or a cost segregation study where we go in and, just as the name mentions, we segregate the costs of the building. So when you buy a residential unit, for example, you're not just buying the land and the walls, you're buying a few appliances, you're buying some fencing around the property, you're buying a driveway, some flooring. All those things I mentioned, the IRS says depreciate at a faster rate than 27 and a half years. And so a cost segregation study goes in and takes your $275,000 purchase price and we segregate that into the different asset classes. So we say, okay, of your 275, $16,284 was for your appliances. $8,412 was for your fence. We put values to all those different components, which now allows you and your tax preparer to depreciate those at a faster rate. So, normally when you buy a property, you give your closing statement to your tax preparer, and they just see that you've bought a property for 275,000, but they have no idea if there's carpet in that building, and they certainly don't know what the value of that carpet is. And so that's where a cost segregation study comes in, is to put cost to those different components of your asset.
Wow. Yeah. Lot going on there. First question that comes to mind is, can you only do cost segregation for non-owner occupant investment properties or commercial properties? Does it apply to single family homes? How does the IRS treat that?
Yeah, that's a good question. So cost segregation can be done on any revenue generating property. So anything other than your primary residence. Um, so, ADUs, single family homes, short term rentals, all the way up to ski resorts and retail strip malls. Um, Anything that's generating revenue, you can take depreciation on, and anything you can take depreciation on, you can accelerate in, the form of cost segregation.
Interesting. Okay. Now, I do a lot of brokerage sales. I work with a lot of investors, as I'm sure you do. Does when you let's say you one of our clients is a high income W-2 earner. And is it true that, he can only, in one calendar year, he can only take up to, I think it's 25,000 around in losses in 1 year? Would this count? Would this supersede that? If he cost segged and wanted to capture all of that depreciation in one calendar year, could he write off more than 25,000, or does this still apply to that until you become full-time real estate status is in the eyes of the IRS?
Yeah, that's a great question. So I think what you're getting at is there's something called passive income and there's something called active income. So I'll use a doctor as an example. A doctor
Yeah,
might make $400,000 a year doing their doctor practice, and then they own some real estate on the side.
right.
If we do a cost segregation study on that real estate, let's say we create a $100,000 deduction, that $100,000 deduction cannot be used to offset their 400,000 of doctor income. They still have to pay tax on that active income. The reason for that is because your real estate is passive, you're doing it on the side. When we do the cost segregation study, those deductions also get marked as passive, and they can only be used to offset passive income. So, in the doctor scenario, if the doctor's real estate is making $200,000 a year, then we can offset 100,000 of that. So the doctor now is only paying tax on 100,000 of their real estate income, but they're still going to be paying tax on 100% of their $400,000 doctor income. So that's because that's their active income versus their passive income. Now there are a few ways around that. And to get back to your $25,000 point, if you make less than $150,000 a year in your active job, you can take 25,000 up to 25,000 from your passive deductions and apply it to your active income. But once you hit the $150,000 of active income, that kind of phases out, and so you're capped at that 25,000. So, in saying that, there's a couple ways around that. One thing you mentioned is becoming a real estate professional for tax purposes. So, like oftentimes, a doctor who makes $400,000 or $500,000 a year in their doctor income, their spouse may have the luxury of staying at home. And so, if the spouse stays at home and manages their real estate, well, all of a sudden, the spouse becomes a real estate professional for tax purposes. And if they file a joint tax return, then all of a sudden, those deductions from your real estate can be offset against your W 2 income. So to become a real estate professional, there's two tests you have to meet. One is you have to spend 750 hours a year doing real estate activities. That's about 15 hours a week. And the other test, which is a little harder, is you have to spend 51% of your working time doing real estate. So I'll give you a real life example. I'm a W-2 employee here at Maven Cost Seg, and my wife is in the school district. And we have rental properties on the side. If I do a cost seg study on my rental properties, I cannot use those to offset me and my spouse's W-2 income. But if my spouse were to quit her job at the school district and become a real estate professional and manage our properties, and if she meets those two tests, then all of a sudden we can use those deductions on our real estate to offset our active income. So the first way to get past that is become a real estate professional, which is not always easy to do for those of us who have full-time W-2 jobs. The other way around that is something called the short-term rental loophole, which I'm not sure if you've heard of that, but basically the IRS says if the average stay in your home is less than 7 days, and you yourself can show that you materially participate in the management of that home, then we're no longer going to look at your home as a rental property. We're now going to look at your home as basically a hotel. So it looks like you're running and operating a hotel business. So back to my personal example, I knew what year was it? I think it was 2022. I had a tax liability. I had a high income year for W-2 income, and I was going to owe a lot of taxes. So at the end of and I had some real estate on the side already, but I knew if I did cost segregation studies on that real estate, I couldn't use those deductions to offset my active income because those were long-term rentals. So I went out at the end of the year and I went and bought a short-term rental, actually in about September. I went and bought a short-term rental. I Two tests you have to meet. One is the average stay has to be less than 7 days, which typically on your Airbnb type properties it always is. The second test is you have to show material participation. In order to show material participation, the IRS gives us 7 different tests to meet, and we only have to meet one of those 7 tests. The test that I met was I spent 100 hours at the property before the end of the year and more time than anybody else. So more time than the cleaner, more time than the maintenance folks. And because of that, that short-term rental, now basically the IRS looks at that like, hey, you're owning and operating a hotel. And because you're actively managing that hotel, those deductions are active and they can be used to offset your active income. So we did a cost seg study on that property. I put $80,000 down on a $400,000 property. We did a cost seg study, got about $148,000 deduction, which equated to about a $48,000 tax savings. So I put 80 down, but I also got 48 back when I filed my taxes. And so that 48,000, I would have just sent that off to the government in the form of taxes had I not done the short-term rental loophole. So that gives you kind of an idea of the active versus passive, but there are a few ways around that where you can take advantage of some of the depreciation.
Wow. That is amazing. I did not know about the short-term rental loophole for active W-2 employees that may be high-income earners like that. That's really, I mean, this episode alone is worth that weight in gold. I don't know many people who know that. So,
Yeah,
um,
you see a lot of high W-2 earners going out and buying short-term rentals just for that reason. Like I can either give my money to the IRS or I can go
yeah,
buy a revenue-generating property and create wealth over time. I would much rather do that. And actually, I'll be honest with you, the Airbnb that I bought, it doesn't create a lot of cash flow every year. It basically breaks even, but the property itself is appreciating over time, and I saved $45,000 in taxes that I would have had to pay. So for me, it was worth making that investment.
yeah. So now let me ask you. So you did a cost seg on that short-term rental, which is great. You've basically because that was a single family, I think you said. So that would normally be depreciated over 27 and a half years. You've now kind of fast forwarded that entire depreciation. So in years 2 through 27, you are not taking any further depreciation on that, right? Because you've already taken it all essentially.
No, actually, I still am. So when we do cost segregation, we usually segregate around 30% of
Oh,
your depreciable basis. So remember, depreciable basis is your purchase price minus land because we don't ever get to depreciate land. So you
hmm,
take your purchase price minus land, and we usually will find about 30% of that that falls into short life categories. The remaining 70%, it stays in that long life, the 27 and a half or 39-year bucket, and you're still getting your 127th or 139th of the 70% of your building. It's just that we're taking 30% and front loading it into the early years. So you're getting that as kind of a bump in those early years.
got it. Okay. Now, how long? So you said you bought that in September. Where
Mhm.
the filming of this episode is October 15th, actually. So before the new year comes, if I wanted, in actually real life, as far as investments go, my partner and I are gonna, do a consultation call with you in the next couple of days, which is going to be great. So if we wanted to cost seg some of our property, are we still eligible this year? How long does that take? I have a meeting with, selfishly meeting with my accountant next week just to do some tax preparation, which is why I want to get you involved for the cost seg. So is it attainable to do a cost seg on a few properties this year and get those deductions?
Yeah, absolutely. So the nice thing about cost segregation is it doesn't actually have to be done until you file your taxes. So we
Oh,
don't actually have to have the studies done until at latest next October. Let's say you extend your 2025 taxes and you don't file in April, you extend. So technically, you have until October 15th of next year. We really have all of next year until October to get those cost seg studies done. Now, a lot of tax advisors will say, let's get them done before April because in April, even if you extend, you still have to tell the government and you have to make a payment on your estimated taxes. So you say, hey, I'm not done with my taxes yet, but I think I'm going to owe you this much. And so you have to write them a check, and then you have until October 15th to file. If in fact in October you decide that you overpaid them, then they'll refund you money. And so we like to get the studies done prior to April so that you can include them in your estimated taxes. So basically say, hey, IRS, it's April 15th. I'm going to extend, but I've run my taxes and actually you guys owe me a huge refund. And so you don't have to write a check in April to the IRS. So yeah, you have until really October 15th of next year should you decide to extend.
Okay. Oh, good to know. And how long does a typical study take?
So cost segregation studies usually take around 4 weeks to complete once
Yeah.
you've engaged us. So the first thing we'll do is we'll run a preliminary analysis first, give you an idea of the estimated tax savings and what our fee would be. And then you'll share that with your tax preparer. You'll make sure that you can utilize the deductions. And then you will engage with us. And at that point, we'll get the site visit scheduled, go look at the property, and then we'll have about a 40 to 60 page report back to you, a couple of weeks after that.
Okay. That's so it is if we started now, let's say, and hired you, you could complete it by April. What
Oh, yeah.
yeah, no
Yeah.
problem.
Yeah. Now is the best time. Like we get
Yeah.
fairly busy come February. That's
Okay.
like when everyone starts thinking about their taxes. So come February, we get slammed. But yeah, between now and February is a great time to get started.
And the depreciation recapture. So let's say I own a property now and I want to depreciate it for this calendar year's tax savings, but I know I'm gonna sell it in the next 2 to 3 years. Is it still worth doing? Should I hold off? How do you treat that?
Yeah, no, that's a great question. So a question we get asked probably most often is, well, Eric, isn't this just a timing issue? Because if I take all this depreciation up front, when I sell the property in a couple of years, don't I have to pay it all back? And the answer is no, not necessarily. You do have to pay some of it back in the form of depreciation recapture. So anytime you sell an asset, you pay two types of tax. You pay capital gains tax and you pay depreciation recapture. The depreciation recapture is calculated based on the amount of depreciation you've taken. So I'm sitting here saying, hey, let's front load a lot of this. And that's why we get the question quite often. Well, the idea behind cost segregation is you take your deduction this year against your ordinary income rate. So let's say your income bracket is you're in a 35% tax bracket. So you're going to take your deduction this year against income that's going to be taxed at 35%. In 2 or 3 years, when you sell it, you're going to pay back some of that at a 20% capital gains rate or a 25% recapture rate and save the spread. And the reason I say you're not going to pay it all back is because I'll actually back into this example because I think it makes more sense. But let's say you buy a property for $1 million this year, you do a cost seg study, and then in 2 to 3 years you sell it. Let's say the market is on fire and you sell it for 2 million, just to make the math easy. So you bought it for $1 million, you sell it 3 years later for 2 million. When you go to settle up with the IRS, you're telling them that everything is doubled in value, right? Your You bought this building and all this stuff for $1 million. You're now selling this building and all the stuff in it for 2 million, so everything's doubled in value. Well, your land and your walls have gone up in value, but certainly your dirty stained carpet that's 5 years old or 3 years old or whatever it is not gone up in value. That goes down in value. Carpet is actually a 5 year asset. So after owning your carpet for 5 years, it has zero book value. So let's say you held that property for 5 years. When you go to sell it, you pay no recapture tax on your carpet. You pay no recapture tax on your appliances. Any of those 5 year assets, you pay no recapture tax on. Your 7 year assets, you're going to basically pay 2/7 back on that. And then your 15 year assets, if you own it for 5 years, you're going to pay 10/15 back. But the idea is you're paying some of it back at a lesser rate and saving the spread. So I've kind of run some scenarios where even if you have a property for just 1 year, one taxable year, if your property has a depreciable basis over $500,000 and you're in at least a 30% tax bracket, then that rate arbitrage between 30% and 20% even if you only own it for 1 year, you're going to come out net positive in your overall tax savings.
Wow.
So
And when,
smaller properties, it doesn't make sense if you're only going to hold it for a year or two. But anything over 500,000, you're going to come out positive by doing a cost seg study.
and by hiring you guys, you will give me kind of a benefit analysis. Is this worth to do or not? Right.
Yeah,
Essentially, right?
absolutely.
Yeah.
Yeah, we'll ask you those questions. You plan on holding it? What'd you pay
Yeah.
for it? Um, and we'll run an analysis, and then you share that with your tax preparer, and you guys decide if this is the right year.
What about property that I've owned in the past and I've sold, and I never did cost seg study on it? Are you able to backdating cost seg those properties?
Um, yes and no. So I'll give you two examples. You said you own the property in the past and you have sold it. The answer is probably we can't do a cost seg study because it's already been sold. Where we can do a cost seg study is if you sold it in 2025. So let's say you bought a property in 2020, you sold it in February of 2025, and you haven't filed your 2025 taxes yet. We can still go back and do a cost seg study and take advantage of those deductions. Um, Now, you can do cost segregation on assets that you bought many years ago. Let's say you bought it 7 years ago and you still own it. You can still do a cost seg study on that, bring all that missed depreciation forward and drop it on your current tax return without having to amend any prior years, which is great.
That's
So there's an
huge.
extra, yeah, there's huge. There's an extra tax form called the 3115. It's a change in accounting method, but you're basically letting the IRS know, hey, IRS, I've been taking my standard deduction for the last 7 years, my 127th. I now have accelerated it through a cost segregation study, and I'm going to take a big chunk of missed depreciation all in my current tax year, and you don't have to amend. And so that's one of the most powerful things about cost segregation is you don't have to use cost segregation in the year you buy the asset. You maybe just keep it in your pocket because let's say you don't have a high income year, or maybe you've got a bunch of other write offs because you did a bunch of renovations to the property. You don't have to do cost segregation this year. Just keep it in your pocket. Next year, when your rents go up and your deductions go down, and all of a sudden you show a bunch of income, do cost segregation next year or do it in 2 years. And so it's not uncommon for us as we meet people across the country when we're speaking on this. They'll come up to us and say, hey, I've got 14 properties. Can you run an analysis on my whole portfolio? And we'll do that. We'll run an analysis on all 14 properties and say, okay, on property A, you're going to get an $80,000 deduction. On property B, you're going to get a $200,000 deduction. And now you've got this summary of all these deductions. And now you take that to your tax preparer and say, okay, tax preparer, what is my income this year? And they're like, oh, well, you look like you're going to be paying taxes on about 400,000 of income. Okay, well, great. Well, I go look at my summary sheet and I say, okay, I've got 400,000 of income. Let me go find $400,000 of deduction so I pay no tax. So maybe you do properties 1, 2, and 7 in that example, and that gives you enough deduction. Then you just keep your portfolio, the rest of those properties, you keep it in your back pocket, and next year you do the same exercise. And so it's a great way to grow your wealth faster because you're not paying so much tax. You're taking this tax savings and you're reinvesting in properties. You're paying down your debt. You're, hell, I don't know, go buy some Bitcoin and do whatever you want with your tax savings, but at least don't give it to the government and let them mess around with it. So,
Yeah, wow. That I can't wait to have this call. I think it's next week we're doing it. So
yeah,
that's amazing. Thank you. So I know there's some uh, opportunity zones where this could come into play. Do you mind touching two things? I want you to talk about opportunity zones and cost seg, and also some of the changes to the big beautiful bill that is now in place and
yeah,
how that plays out.
yeah. Let's start with the big beautiful bill. So
Okay.
there were a few changes. The biggest change when it comes to real estate investors is they reinstated what we call a 100% bonus. So 100% bonus depreciation. The government uses bonus depreciation to kind of stimulate the economy. So if the economy's not doing well, they'll say, hey, people, we're going to give you an extra incentive to go out and buy stuff. So we're going to give you 50% bonus or 80% bonus. And all that means is that if you go out and buy a bulldozer, for example, for your landscaping company, and you spend $1 million on that bulldozer, and let's say you buy it in a year where they're offering 50% bonus depreciation, that $1 million bulldozer, you now get to take 50% of the deduction all in the first year, or 500,000 all in the first year. So you can see how this would incentivize people to go out and buy stuff at the end of the year because, hey, I have $500,000 of income at my landscaping company. I need a bulldozer anyways, so let me go buy a bulldozer, get a $500,000 deduction, and now that offsets my 500,000 of landscaping money. So bonus depreciation, that's kind of how bonus depreciation came about. And I don't think that when they came up with bonus depreciation, I don't think they even applied it to real estate because real estate, in order to take a bonus depreciation on an asset, that asset has to have a useful life of 20 years or less. Well, real estate for residential is 27 and a half years and commercial is 39 years. So I think in Congress, when they came up with this bonus idea, they never thought about it applying to real estate. Back in, I think it was 1994, there's a company called Hospital Corporation of America. They own and operate a bunch of hospitals out in the mid-Atlantic area. And they had a huge tax liability. They said, well, this is crazy because when I buy a hospital, I'm not just buying the land and the walls again. I'm buying a bunch of linoleum flooring and a bunch of cabinets and countertops and all these different things. Are they eligible for bonus? And they're not unless you can segregate them out. So a cost segregation study is super important because we're going to take that single family home you buy that normally you would just depreciate one asset over 27 and a half years. We're going to segregate that into 5, 7, and 15-year buckets. And now all of a sudden your 5, 7, and 15-year buckets are eligible for bonus. So with the big, beautiful bill, they reinstated 100% bonus, which is huge. So now when you do a cost seg study, we usually segregate around 30% of your asset. So again, to make the math easy, let's say you've got a $1 million asset. We're going to find $300,000 worth of stuff that goes into that 5, 7, and 15-year bucket. And now with this 100% bonus, you get to take 100% of your 5, 7, and 15-year stuff all in year one. Prior to this, you would have to take your 5-year assets and split it up over 5 years, your 7-year assets and split it up over 7, your 15 and split it up over 15. But now you get 100% of that all in the first year. And so on a $1 million asset, you're going to get a $300,000 write-off in the first year. So that $300,000 write-off, if it comes off of your income, if you're in a 35% tax bracket, that's $105,000 tax savings on a $1 million asset. So that's basically 10% back. So if you put 20% down on your $1 million asset, you're getting 10% back just by doing a cost segregation study and taking advantage of this 100% bonus.
Wow. And going back to that bulldozer construction worker example you gave, he goes out and buys $1 million bulldozer. Does it matter if he financed it or does he have to pay it in cash to get that 100% depreciation?
That's the beauty of it. You just finance it. So
put as little down as you want
you
possible.
put as little down as you want. And you might, I've seen real estate deals where you invest less money than you're actually getting back in tax savings by the way
that's incredible.
Yeah. So, if you can find something and leverage it, there's all kinds of different variables that go into how much you want to leverage or not. But from a pure tax perspective, the more you can leverage, the more benefit you get because the less money you're having to come out of pocket for all of these deductions.
Wow. Do you ever see people, do these for like sports cars and for, I don't know, different things? You could say it's for business use, right? Do you ever see any of that happen?
Yeah, there's a tax law though that's on the books now where you're eligible to take 100% deduction on your car if it meets certain criteria. I think it has to be over 6,000 gross vehicle weight.
Yeah, curb weight.
Yeah. So you see a lot of people going out and buy Ford Raptors at the end of the year and using them for business. Like you can't go out and buy a Corvette because it's not really a in that example of the landscaper, it's hard to say that you're using your Corvette for landscaping, right?
I know, yeah. I was just curious.
But with a heavy vehicle like a big work van or a big work truck, if the gross vehicle weight is over 6,000, then the IRS lets you basically write that whole thing off in the first year. Now, there's other things you gotta use it for business purposes and all that other stuff, but that's the
Yeah.
idea.
I did that. I have a SUV that I did that last year with.
Oh, okay.
Placed into service. It was over 6,000 pounds, and took that bonus depreciation. And I assume if you can do it on multiple cars, if they meet that criteria, right?
Yeah, yeah. If you can say that, it's hard to do like if you're just running your own business because the
Yeah.
IRS is going to say, why do you need three Ford Raptors to if you're the only employee?
Right. Yeah.
But as long as the majority of the use of that car is for a business purpose, then yeah, you can write it off.
That makes sense. Wow. Do you mind touching upon opportunity zones real quick?
Yeah, just with the changes to the big beautiful bill, there was two other things that really impact real estate investors. One of them was opportunity zones got expanded and made permanent. So there was before the big beautiful bill, opportunity zones were set to expire. And for those of you that don't know what an opportunity zone is, it's a way to defer your capital gains. So the government has established certain zip codes and zones within communities. So usually in low income areas, which when that first came out, I'm like, oh, I don't want to go invest, on the wrong side of the tracks because that's not a great place to invest. But what I found was that these opportunity zones aren't necessarily in bad areas. So the way the opportunity zones were established was based off census data and income. So I know a lot of great areas where there's maybe a lot of, college towns where there's majority of the people who live there are students and they don't have a lot of income. That doesn't mean it's a bad part of town. It just means it's a college town. Well, those are in opportunity zones. So you could go build a multifamily in there and have huge tax benefits. And the way that works is opportunity zones allow you to take capital gains from either the sale of a business or the sale of a piece of real estate. You take those capital gains, you invest it in one of these areas, and by investing it in that area, if you hold that property for at least 10 years, whatever that capital gain grows into, let's say it doubles or triples or quadruples over those 10 years, when you pull that capital gain out, you pay no tax on that. So you're saving 20% tax on whatever that grows into. And so a lot of now there's some nuances to it. You have to improve the property. You can't just buy an old building in a bad part of town and sit on it for 10 years. Um, you have to improve it dollar for what you spend. So a lot of investors are taking and buying raw land and then developing multifamily and that type of thing on it. So opportunity zones, they were set to expire with the big beautiful bill. They're made permanent. I use that word permanent loosely because permanent in the eyes of the IRS basically means until we get a new administration or they decide to change the tax law. But
Yep.
for the time being, it's permanent, which does make it easier for us to tax plan. And then they've expanded some of the rural opportunity zone criteria. So um, if you just Google opportunity zones, you can find the opportunity zones in your area or in the areas you invest. And it's definitely worth looking into if you have a large capital gain that you're trying to defer. So I would look into that. And then the other thing is the qualified production property. So I know on the campaign trail, you heard a lot about bringing manufacturing back here to the United States. And so the government, as part of their tax code, has incentivized investors to build manufacturing facilities. So if your manufacturing facility that you build meets certain criteria, then you may be able to write off that whole construction cost in the first year. So it's only the part of the building where there's actual manufacturing happening. So if you've got an office on half the building and manufacturing on the other half, you would only be able to write off the half where the manufacturing was happening. But that can create huge, huge deductions for developers or anybody building manufacturing facilities. And it's not even, there's still some guidance that needs to come out around this. It's fairly new. They just passed the bill, in July? So there's still some stuff that needs to come out. But when I think of manufacturing, I think, oh well, I don't invest in a big warehouse where they're building cars and stuff. But manufacturing doesn't necessarily mean you're building a warehouse or a manufacturing facility where they build cars. There's all kinds of manufacturing facilities that fall under the manufacturing definition. And so maybe you have a silk screening shop where you're basically manufacturing shirts or putting shirts together. Sometimes those may qualify. So it's a lot of businesses that I think can benefit from this that don't realize it. And so it's just something to be aware of because it's definitely new and it's definitely not fully understood by a lot of people out there. And so just something to be aware of as an investor.
Awesome, awesome, awesome. Well, Erik, that was a lot. That was all good stuff. I can't wait for our call next week to see what we can do for some of our properties for cost seg. If people want to find more about you, should they go to mavencostseg.com or where should they go?
Yeah, you can find my information. It's just mavencostseg.com/Erik. My contact information will be there. Please, you guys, use me as a resource. I'm happy to take your call. I try to answer my cell phone whenever I can. I don't bill by the hour. So if you just have questions or want to bounce ideas off, I don't know anything about earned business income or child tax credits. I'm not a CPA. So if you have tax questions, call your CPA. But if you have questions about depreciation or real estate tax, I can usually answer them. And if I can't answer them, I've got a network of resources that can get the answer for you. So, yeah, please use this as a resource. If you've got any properties you want us to look at, you can go to that mavencostseg.com/Erik. We'll do a free analysis on your property. Usually turn those around in 24 to 48 hours. So, but yeah,
Awesome.
please use this as a resource.
Thank you, thank you. And for all the listeners out there, if you like what you heard today, be sure to like and subscribe. Sky's the Limit podcast available on Apple, Spotify, and our website. So, thank you again, Erik. Appreciate your time, and we'll be in touch.
All right, sounds good.
See you later. Thank you for watching Sky's the Limit. We're always releasing new real estate content, so if there's something you want to hear, be sure to leave a comment. And don't forget to subscribe to our channel.